My name is Mukami Njeru. I'm here in my capacity as one of the directors of the Actuarial Academy of East Africa, which is a non-profit organization building, the actuarial profession in the East African region. We have 3 pillars within the Actuarial Academy of East Africa, and today we are here with the university pillar, which is the pillar dedicated towards ensuring the next generation of talent that comes into the pipeline is where it needs to be. And we're really privileged that a lot of you are able to join us from different faculty across the region and even outside the region. So a warm welcome to those joining us for the first time. This is actually our second university faculty event. We had one last year where we focused on accreditation processes for our local universities. We had representatives from the SOA, IFOA, and CAS to sort of take us through that process. And we know that, there's a lot of good feedback around the benefit of that. We also had an example of a university that had been recently accredited, the University of Lagos. And we know that some of the universities have since progressed on their journey. So we really believe in this cause and will continue to, empower the local universities to really be the tool to build the future of the profession. So on to today, where we have our 2024 Actuarial Academy of East Africa University Support University Faculty Summit. The aim of this summit is to bring together educators, industry professionals, and thought leaders to explore the integration of interdisciplinary approaches within actuarial education. This summit is a platform for discussions on enhancing the actuarial curriculum to meet the evolving demands of the profession within our region, particularly incorporating skills from wider fields such as data science and sustainability. We're very excited to have a great panel of speakers who I will introduce the first shortly. But basically, it's to design an inspiration of new thinking to drive the future of actuarial education towards a more integrated and comprehensive approach. So on to the introduction of Mr. Paul Sweeting, or should I call you Dr. Paul Sweeting? So Paul is currently a senior advisor at Hassana Investment Company, following being the governor or assistant for financial sustainability and risk management at the General Organization for Social Insurance in Saudi Arabia. Before joining this, he was Hassana's CRO. And immediately prior to this, and not necessarily more importantly, but more famously, Paul Sweeting was a professor of actuarial science at the University of Kent, where he taught enterprise risk management. He remains an honorary professor at Kent and has also written a textbook, Financial Enterprise Risk Management, used by actuarial associations around the world for the Chartered Enterprise Risk Actuary qualification. As a CIRA, I was very excited that Paul took on this presentation, but also really that Paul has recently stepped up to be part of the international or global actuarial profession in the UK, or the UK branch of it, as the president-elect of the Council of the Institute and Faculty of Actuaries. So I think it's something we're very excited to see come forward. And I know that this topic is close to his heart. So yes, without further ado, I will ask Paul to take the first session, where he tells us about a bit of his experience in actuarial education, but really inspires us in terms of how to move forward to continue to evolve in this sector. Over to you, Paul.
Thank you very much, Mukami, and thank you everyone for joining. So I'm going to be talking about the future role of actuaries, but I think one of the easiest ways of doing this is to talk about the past and to talk about my career so far, partly because it's always nice to talk about yourself, partly because if I'm going to talk about my career, there's a lot more that's gone before than is likely to come ahead, because I've been doing this job for over 30 years. But also because I think that history is usually a pretty good indication of the future, and a lot of things have changed through my career, and I think these can give us an indication of how things might change in the future, where opportunities might be, how we can take advantage of them, and so on. So I'll happily answer any questions through my talk. I believe I'm scheduled to talk for about 30 minutes with 15 minutes of questions. If that's not right, someone can step in and tell me to be quiet when I've talked for too long, but hopefully I'll be able to share some useful insights. So I joined the actuarial profession towards the end of the last century. In 1992, I started. And I started at what was then a small firm called Barnett Waddingham. There were about 30 people in the firm in total. There's about 12 in the London office, 12 in Buckinghamshire, 3 or 4 in Leeds, and a couple over in Luxembourg. There's now about 1,500 to 2,000 people work for Barnett Waddingham, so it's changed quite a bit. But when I was there, it was a small and growing firm. And I remember when I was there was a display that we had of these old calculating machines, which were sort of mechanical things with dials on which you turned and cranked a handle and it gave you the answers. Because that's how people used to have to do calculations before I joined. I mean, we'd discovered electricity by the time I started work, but that was what people used to use, that and squared paper. And when I joined, we did have desktop computers, we did have handheld calculators, so we'd moved forward a little bit in terms of technology, but we didn't have laptops because they were too expensive and too slow. But they did come along. When we had connections on our network, the connections between computers were using network cables where if you unplugged one from the back of any computer, the whole network went down. And when we connected the office between our London and Buckinghamshire office, that was done using dual ISDN leads, which gave us a total transmission speed of about 128K, I think, which was faster than the modems that we had, but somewhat less than the gigabit internet speed that you can get over your phone these days. And we tend to use things like commutation functions because cash flow analysis just, the spreadsheets couldn't handle it. So they would have crashed if we'd tried to do that kind of analysis, or you'd need to set them running overnight, which just wasn't really practical. So clearly, to get to where we got to compared to where my bosses got to, my bosses, when they started, it was squared paper and slide rules and things like that to do calculations. And we had things much easier. But this didn't put actuaries out of work. The number of actuaries grew. And if I look at where we are now with AI and with machine learning and with people able to model copular functions on their phone. I know someone who did that the other day. He did some copular modeling on his mobile phone. With the vast amounts of data coming in, this is something which has been happening over the decades that I've been working. And again, the number of actuaries hasn't shrunk as work's got easier. It's grown because the opportunity to do more accurate, more useful, a broader range of calculations has grown. So when I think about opportunities for the future and things like AI and machine learning and generative AI and large language models, things like that, I don't think they are likely to reduce the work that actuaries have to do. I think they are likely in the long run to increase the opportunities that we have, because there'll be more tools and there'll be more data, and it'll be even more important that the people using those tools and using the data understand what is going on. And that's really one of the key areas I think that actuaries will be able to add value going forward. Also, around the start of my career, I remember that, and many of you that worked in consulting or worked in industry, I'm sure will have had a similar experience, where you'll put together a report, and you'll work hard on all the numbers, and you submit the report to senior partner, and the partner will read through it and will point at a number and say, I don't believe that. That doesn't look right. And you think, how on earth can it not look right? I've done the calculation. So you go back, you check them, and the senior partner is right. You're wrong. You made a mistake. And now I'm at towards the other end of my career. When people bring me reports, I'll look through them and I'll say, that doesn't look right. And they'll go away and they'll check, and usually I'll be correct. The number isn't right. And that's because I understand what's going on in the underlying calculations. And it's because when I gave reports to my seniors before, they understood what was going on in the underlying calculations. They understood the maths, and they'd done enough of this stuff to know what the answer should be. And that, again, is one of the areas where I think that we are going to be able to add value going forward. When we look at things like machine learning in particular, which I think is a really interesting area, data science. A lot of the models that get used currently in credit modeling, but will, I'm sure, come to general insurance, things like support vector machines, k-nearest neighbor, that kind of more difficult maths, which needs to be understood, needs to be appreciated. You need to know what the model is doing before you use it. A lot of data scientists, I don't think, do. A lot of data scientists might have a broad idea of what's going on, and they'll understand how to run this stuff in R in a few lines of code, but they won't actually really understand the maths. Actuaries should be able to understand the maths behind this, and therefore should have an appreciation of what right looks like and what wrong looks like. So that is an area where I think we will have an advantage, because the people that are just crunching the numbers and not understanding what's going on, they're going to make mistakes. They're going to not necessarily sense check the numbers that are coming out of there. And the other area where I think we can add value in this kind of part of actuarial work is being able to give professional oversight and understand the context of what it is that we are doing, whether it's some of the more data sciencey AI things, or whether it's something broader. So on that side of things, I'm optimistic for the future of actuaries in the profession, because I think that the range of techniques and the volume of data and the range of problems to which data can be applied are going to grow significantly, and actuaries are going to be the ones that are best placed to do that. Now, having said that, I don't think that this means that employers or people with problems are going to look at the data and the problems that they have and say, what we really need to solve this is an actuary. I don't think that's how it works, and it's certainly not how my career has worked. My career has, any success I've had in my career haven't been because I've had certain letters after my name. It's been because whoever I've been working for or working with has had some problems, had some challenges, and I've been able to solve those problems. Now, it just so happens that the reason I've been able to solve those problems is because I'm an actuary and because of my actuarial training. But they didn't hire me because I'm an actuary. They hired me because I could solve problems. And I'll talk about some of those when I talk about aspects of my career where I have been able to help. So I started, as I say, at Barnett Waddingham in the 1990s as a pensions actuary, a trainee pensions actuary. And that's what I did for most of the first 6 years of my career. But as I was doing it, I was getting more and more interested on the investment side. And I actually wanted to work in investment before I became an actuary, before I knew what an actuary was. I'd joined an investment bank called Kleinwort Benson for a summer job in 1991, I think it was. And when I was there over the summer, after I'd been there for about 3 weeks, the head of the department came back after his summer holiday. And he was hugely well respected, and nobody seemed to mind that he'd taken 3 weeks off over the middle of summer. That seemed to be fine. And they had this sort of no smoking rule in the office even back then, which didn't stop him from wandering around smoking a big cigar. And everybody just thought he was great and talked about how high steam, which, and it turned out he's an actuary. So I want to do what you do. I want to be able to wander around smoking a big cigar with all of this respect. So what I initially wanted to do was get any job as an actuary, qualify, and then go and work in investment banking. I've never worked in investment banking. I decided I didn't actually want to get up as early as you needed to get up to be an investment banker, but I was still interested in investment and asset management. So how do you get to asset management from pensions consultancy? Well, the way that I did it, and something which has worked pretty well for actuaries over the years, is through adjacency. So if you're working in pensions consultancy and it's a small consultancy, then one of the things that you can do is try to help pension plans with other problems they have, like what investments should they hold. So I started doing some bits of investment consulting already whilst I was working in a pensions consultancy. And this gave me enough experience that I was able to move to a full-time investment consulting job, which was my second job, and get more involved in analysing managers, in building strategic asset allocations, in understanding stochastic asset allocation models, asset liability models, and so on and so forth. And this was great, and this gave me a good grounding, which ultimately I was able to use to get into asset management. And one of the reasons that, well, there's a few reasons that I was able to do this, to move from investment consulting to asset management. The first was I've built up relationships in asset management whilst I was in investment consulting, because as an investment consultant, you act as a gatekeeper, which means you end up talking to lots of asset managers. So I kind of knew what they did, who they were, who to speak to. The other thing which helped was asset managers on the institutional side. A lot of what they want to do is sell to institutions. They want to sell to pension schemes. They want to sell to insurance companies, and it's much easier to sell to pension schemes and insurance companies if you understand what it is they actually want the investments to do in the first place. So unless they've got really strong performance, asset managers can have quite a hard time having conversations with these types of institutions, because they've got to rely on the fact that they can say, invest with us, we've had the best return. And that's kind of okay. If you've had really good return, then you'll always be able to get conversations. It's a much easier conversation to have if you want to say, what are you trying to do with your investments? How can we help you solve the problems that you've got? Let's talk about your liabilities, and let's talk about how investments that we have could help solve the problems that you have. So then you're moving away from selling products to selling solutions. And that's a much easier conversation to have, because again, you're going there to solve problems. Now, did I get the jobs in asset management because I was an actuary? Well, kind of indirectly, yeah, but I really got them because I was able to say, if you employ me, then I can help you with these conversations with your clients. I can help you solve the problem of what do we talk about when we go in there. And several of my jobs in asset management have involved that, having and starting conversations, which has been great, because people are much happier to talk to you if you're helping to solve their problems than if you're trying to sell them something. So that's one of the reasons, is because I did understand the clients, but the other was because I was helping both the managers and the clients solve problems, and they didn't care that I was an actuary. They just cared that I could solve problems. So adjacency there is a really good way of making those kind of moves from pensions to investment consulting, to investment consulting to asset management. So that's worked quite well, and it's worked well for the profession around the world as well. So if you look at general insurance, and actuaries are synonymous with general insurance now, but 50 years ago that wasn't the case. And it really became the case in the UK because life actuaries could look over the fence at their non-life colleagues in the same firm who weren't actuaries and say, you've got data there. I think we could do something a bit more useful with that data than you're doing. And that gave the firms a pricing advantage. It made them happy to employ actuaries on the non-life side, and it made the non-life business something which was helpful. And in South Africa, you have bank assurance. So you have banks and insurance companies in the same businesses, and actuaries there are able to look over from the insurance, the banking side, and say, you've got some numbers there. I think there's something we could help with in terms of credit risk, portfolios of loans, and so on. And that was how actuaries found their way into the banking system in South Africa, which, both of these are examples of adjacency, making small moves from established areas to new areas, and showing how you can add value, not showing that because you've got letters after your name, you'd be useful, but through solving problems. So that kind of adjacency point, I think, is really important. Something else which I think is important is that when actuaries have been successful in these kind of areas, it's generally been because they've been acting as individuals. So I'm a strong believer in the bottom-up approach rather than the top-down approach. I don't think that, and this is a sort of a much broader philosophy about what government should do, what professional bodies should do, and so on. I don't think professional bodies should look on the landscape and say, there's no actuaries there. Actuaries could do something there. Let's try and help actuaries get work there. I don't think that's a very sensible approach. A more sensible approach, I think, is for individuals to see opportunities, for individuals to take those opportunities, and for the profession to support them in doing so. So if individuals working in a particular area want to get together and have a conference or just have a working group, then it's good if the profession can support them and facilitate that. But you don't want the profession saying, I think we should be working in agriculture. I'm going to set up an agriculture working party for people who would like to do it. That's the wrong way around in my view. I think it should be down to the individuals to do it. And because the things that I've done, which haven't been really that revolutionary, but it's been moving across areas. It's been me doing it and not using the profession to find opportunities for me. So I think that is quite helpful. So it's not the only way to move, though, I have to say. So when I was working in investment management at Fidelity, I ended up going to a dinner at which there was a senior partner of a well-known pensions consultancy or actuarial consultancy in the UK, and we're talking about longevity modelling. And I was just asking the question, how come we don't have stochastic longevity models in the same way that we've got stochastic asset models? And he said, well, no, that's a ridiculous idea. There's just too much uncertainty. There's no point in modelling it. I thought, well, that's a daft thing to say. I mean, if there's uncertainty, we really should be modelling it. We shouldn't be just saying, oh, it's too hard. So I built a simple longevity model, a simple stochastic longevity model, which was, it wasn't brilliant, but it was easier to implement and understand than Lee Carter, which was the dominant one at the time. I wrote it up as a paper for Staple Actuarial Science, and it won the Best Paper Prize. And there weren't that many people working in longevity as its own study area at that time. And a lot of the people who weren't actuaries. So it's quite fertile ground. I ended up writing a few more papers without any kind of real support or involvement from anybody else, and before you knew it, I was working in asset management, but I was a longevity expert, which was a fairly strange place to be. So I applied for a job at Munich Re to basically develop their longevity reinsurance product, having never worked in insurance in my life and only done longevity work using my own numbers and analysis without any oversight. So that's another way that you can make some of these moves, is if you find something interesting, just do some research on it Ideally look to see what other research is out there and try to connect with other people, which I did in terms of getting stuff published, to make sure that I wasn't talking out of rubbish. And it seems that I wasn't, because I published quite a few papers on that, and some of them have had quite a few references. And I just thought of a new idea for another longevity paper in the last couple of days, which I'm going to start work on soon. But if you think something's interesting, it's easier than ever these days to find out what other work other people have done in that area. You can read up on it. You can look at whether you agree with it or not. You can decide, is there anything which could be done differently there? You can decide, particularly in the part of the world where you are, have these techniques which have been done over and over again on US and UK data, have they been done to the data that we've got in our own markets, which might not be as complete, which might not be as granular, but there's still data there. There's still analysis that can be done in these areas. So that's something else which is a really good way of getting into other areas. And the longevity research area for actuaries now is back at the level that it really should be. Actuaries are back involved as much as they were before. Before I joined the profession. And if you look in the UK in particular, through COVID, the analysis that the COVID Working Party did for the UK actuarial profession was very well recognised, and we were able to add a lot of value there. So I moved to longevity reinsurance, and I developed the model, and then they wanted me to start selling longevity reinsurance, and I don't do sales. That's not me at all. So I'd already been keeping myself fairly busy before this. In my spare time, I'd done a CFA, Chartered Financial Analyst qualification, and I'd done a PhD in finance as well. So I was someone who was an FIA and also a PhD, which is relatively unusual. And what that meant was that when I went to the University of Kent and said, any chance of a job of a professor, they said yes, which was nice. So I went to the University of Kent because I thought I just want to do some more research. And even though everybody is muted there, I can hear the laughter coming back from all the academics there saying, he went to university thinking he'd be able to just do research. I know it doesn't work like that. I now have the experience that you have to try to fight for the time to be able to do research. But I was young and foolish then, and I thought this could be fun. So I went to university to do research, and on the longevity side or on the pension side, but I was also asked to lead a working party through my work at the IFOA. I think it was IFOA then. It might actually still be in the Institute, so it might have been pre-merger. I was on council of the Institute of Actuaries all the way through the merger. And I think I was Institute counsel that they asked me. They said, could I chair a working party on modelling and managing risk? And I said, absolutely not. I don't like chairing working parties. If I chair working parties, what tends to happen is you end up doing 90% of the work and getting 10% of the credit and sharing it with other people. So no, I'm not chairing a working party. I'll write you a paper, but I'm not chairing a working party. So I wrote a paper on modelling and managing risk. And the main premise of the paper was you got all these techniques for dealing with risk across different areas, like life insurance, non-life insurance, in banking, credit risk, and there's a huge range of different techniques, but the different groups don't tend to use the same techniques, which is a bit strange. So if I look at the techniques that were used for modelling credit risk, they're very different to the ones that were used to model non-life insurance risk. But fundamentally, you're looking at pretty similar problems. How likely is something to happen? And if it does happen, how bad is it going to be? There's the questions you're trying to answer, whether you're modelling credit risk or insurance risk. So I was saying, you've got all these techniques. It's probably helpful to look over the fence, see what other people are doing, and see what you can learn. And they have done that since. So GLMs, for example, they weren't really used that much in general insurance when I was writing the paper, but they were used a lot in banking and credit risk, and now they are used much more on the non-life side. So I did this paper. It was very well received, and I was talking to the head of learning at the time, Trevor Watkins, and I said, I hear that you're doing some new subject on enterprise risk management. It kind of sounds similar to the stuff I've been doing in my paper. Shall I try and turn my paper into a book? And he thought this was a good idea. So I got involved in developing the syllabus for enterprise risk management. And as I understood what the syllabus was going to be, I thought, okay, that can be the basis for me writing a book based on my paper. So I mean, the paper that I wrote was probably about 60 pages. The book was about 600 pages. So when I say the basis for the book, it was a very, very thin basis. There's an awful lot of additional research needed to put that book together. But it was really interesting, and it did lead me, not much lead me back. It continued something which I've been doing since I qualified, which was learning stuff. So I said I'd done a PhD. When I did my PhD, that was the first time I came across generalized linear models, because they weren't in the actuarial syllabus. So I had to learn how these things worked. I had to learn how to actually implement GLMs. I had to learn a software program, R, which is what I found, taught myself. And when I started writing the book, I had to learn about copulars. I had to learn about different ways of modeling binary events. So not just GLMs, which I'd thankfully learned about by then, but things like discriminant analysis, things like the k-nearest neighbor approach, things like support vector machines. And these all found their way into the book. Some of them found their way into the ST9, the now SP9, the CIRA course. Some of them didn't, but I thought they were interesting, and I wanted to do them anyway. And I've since gone back and learnt more about these and really dug into the maths, because I think it's really important that we as a profession do understand these techniques in a deeper way than many non-actuarial data scientists would. So that's something which I've been very proud to be involved in, the ERM side. And I'm just finishing off the third edition of the book at the moment. And again, the book, the third edition, will go beyond what is taught in the RM exam, but will hopefully give people a flavour of some of these new techniques that I really think we need to get our head around, so we can become problem solvers who really understand the nature of the tools that's being used, and understand how we can continue to be problem solvers. And to finish off, one thing which I've done more of in this book, but I still have only touched on really compared to what we could do, is sustainability. So a lot of what I put in the book is around regulations on sustainability, on ESG ratings, on how we can view ESG and how it impacts institutions, something called double materiality, so how changes in the climate affect firms and how firms affect the climate. And this is all interesting stuff. But a lot of what we are doing on sustainability and on climate is using projections from other people. It's using projections that other scientists have come up with, and we take it as the basis for our scenarios or whatever. But climate change projections kind of involves time series analysis, lots of data, professional judgment. Kind of think actuaries could do a better job on that than some other people. Certainly could understand some of the limitations of the modelling better than some other people. And this is, when I get some more time, this is going to be one of my next projects, to really start doing some decent climate modelling, which will allow us to look beyond using other people's scenarios to really coming up with some stochastic projections that can give not just financial institutions, but can give anybody that needs to know the implications of climate change some useful stochastic quantile-based results that they can use in their analysis. So that has just been added to my pile of research, what I really need to get my head around and start writing up. So watch this space, and if I haven't done something on that in the next year or so, please come back and chase me and remind me that I said I would. But I will, I believe, start getting back to writing some of these papers and publishing some stuff over the next year or so, I hope. So I'm going to leave it there. I think that's about 30 minutes that I've been talking for. Please ask me anything you'd like to about my career, about the future, about things that you wish I'd talked about and I didn't get around to, or anything else. I'm more than happy to answer any questions.